When we talk to buyers, one of the biggest conversations we have is where the funds are coming for the down payment and closing costs needed for the transaction. Some of the most common places would be your personal checking and or savings account. For most loans, you typically have to provide the two most recent bank statements. The other most common is from the proceeds when you're selling a current home and buying a new home. There's a few others that are pretty common as well. Gift funds from a family member. Maybe you have investment accounts with money market or stocks. You can use those funds as well, or a retirement account. But you do need to be careful when withdrawing funds from a retirement account. Some of them may have a penalty for early withdrawal, plus you'll have to account for any income taxes you may have to pay. Some less common places that people get their funds for down payment and closing costs would be a tax return. During the year, they'll file their taxes and get an income return that can be used to document the funds needed for the transaction. Maybe you received an inheritance from family, that can also be used. You have a business account if you're self-employed, and those funds can be documented properly. If you're lucky enough to have an employer that's willing to give you a gift funds from your employer are also acceptable. Maybe you have a car that you want to sell, or an RV or a boat. With the proper information, you can use those funds as well. One of the harder funds to use are cash on hand. If you have plenty of cash on hand, please be sure to talk to your lender before you deposit those funds, as we want to make sure there's no issues when it comes to using those funds for your transaction. So as you can see, there's quite a few ways that you can document the assets needed for a mortgage transaction.